In June 2020, Wirecard AG, a German payment processing company valued at nearly €25 billion, admitted that €1.9 billion in cash on its balance sheet, nearly a quarter of its total assets, probably never existed. The announcement sent shockwaves through European finance. Wirecard had been a member of Germany's prestigious DAX-30 index, trusted by regulators, audited by Ernst & Young, and celebrated as a rare German technology success story. Within days, the company filed for insolvency. Its CEO was arrested. Its chief operating officer disappeared. And investors worldwide began asking, how did this happen? Wirecard began in 1999 as a small Munich-based firm processing online payments. By the early 2010s, under CEO Markus Braun, the company positioned itself as a high-growth fintech disruptor. Wirecard offered payment processing for e-commerce, mobile payments, and risk management services that attracted clients ranging from online merchants to airlines. Revenue climbed rapidly. In 2018, Wirecard joined the DAX-30, replacing Commerzbank. The company's market capitalization briefly surpassed that of Deutsche Bank, Germany's largest lender. Wirecard was lauded as proof that Germany could compete in the digital economy. Markus Braun, an Austrian-born former consultant, became CEO of Wirecard in 2002. Braun presented himself as a visionary technologist, steering the company into emerging markets and new product lines. He spoke of artificial intelligence, big data, and global expansion. Under his leadership, Wirecard acquired businesses in Asia and the Middle East, often paying high multiples for companies that promised access to fast-growing markets. Braun cultivated a narrative of relentless innovation, and investors rewarded him with soaring stock prices. By 2019, he was one of the wealthiest executives in Germany, holding a stake worth billions. Wirecard's reported revenue and profits surged through the 2010s. The company claimed compound annual growth rates that far exceeded traditional banks and payment processors. It expanded into Asia-Pacific, acquiring stakes in payment firms in India, the Philippines, and Singapore. It entered partnerships with Visa and MasterCard. It processed transactions for major clients, including Aldi, Lidl, and Booking.com. Analysts praised Wirecard's diversification and technology edge. Few questioned whether the numbers were real. As early as 2015, questions began to surface. Investigative journalists at the Financial Times reported irregularities in Wirecard's accounting practices, particularly in its Asian subsidiaries. Short sellers, investors who bet that Wirecard stock would fall, published reports alleging round-tripping of funds, fabricated revenue, and suspicious transactions. Wirecard dismissed these claims as coordinated attacks by speculators seeking to profit from share price declines. German financial regulator BaFin sided with Wirecard, twice filing criminal complaints against journalists and short sellers for alleged market manipulation. The skeptics were marginalized, and Wirecard's stock continued to rise. The Financial Times, led by investigative reporter Dan McCrum, published a series of detailed reports between 2015 and 2019. McCrum's team examined leaked documents, interviewed former employees, and traced transactions through Wirecard's network. They alleged that Wirecard inflated revenue through third-party partnerships in Asia, particularly with companies that existed only on paper. The reports claimed that Wirecard recorded sales from non-existent customers and booked profits from sham transactions. Wirecard responded aggressively, calling the reporting false and defamatory. The company hired law firms and public relations agencies to counter the FT's claims. German prosecutors opened investigations not into Wirecard, but into the FT's sources. A key element of the FT's reporting centered on Wirecard's third-party acquirers, partner companies in Asia that allegedly processed payments on Wirecard's behalf. According to the FT, these entities generated a large share of Wirecard's reported profits. But former employees and leaked documents suggested that many transactions were circular, money moved between Wirecard and its partners, then back again, inflating revenue without genuine customer activity. Wirecard maintained that its third-party model was a legitimate business strategy, designed to enter markets where it lacked direct licenses. Independent verification, however, proved difficult. The third-party acquirers operated in jurisdictions with limited transparency, and Wirecard disclosed few details about their operations. Germany's financial regulator, BaFin, repeatedly defended Wirecard. In 2019, BaFin imposed a 2-month ban on short-selling Wirecard stock, citing the need to protect market integrity. The regulator filed criminal complaints against 2 Financial Times journalists and several short sellers, alleging market manipulation. BaFin's actions sent a clear signal: the German establishment stood behind Wirecard. Critics later argued that BaFin failed to conduct adequate oversight, relying instead on Ernst & Young's audits and accepting Wirecard's assurances at face value. BaFin's president at the time, Felix Heufeld, would later acknowledge that the regulator had been misled. Ernst & Young, one of the Big Four accounting firms, had audited Wirecard's financial statements since 2009. Every year, EY issued unqualified opinions, certifying that Wirecard's accounts presented a true and fair view of its financial position. EY earned millions in fees from Wirecard for audit and consulting services. The firm's stamp of approval reassured investors and regulators. Yet EY later admitted it had failed to obtain sufficient evidence to verify the existence of cash balances held in trust accounts in Asia. In 2020, after Wirecard's collapse, German authorities launched criminal investigations into EY auditors for possible negligence. EY maintained that Wirecard's management had engaged in an elaborate fraud designed to deceive auditors. Under mounting pressure from the FT's reporting and short seller allegations, Wirecard announced in October 2019 that it would commission an independent special audit of its accounting practices. The audit was conducted by KPMG, another Big Four firm. KPMG was granted access to Wirecard's records and interviewed employees and partners. The investigation focused on the third-party acquirer business and revenue recognition practices. Wirecard's management expressed confidence that the audit would vindicate the company. Investors hoped for clarity. Instead, KPMG's findings, released in April 2020, would deepen the crisis. In April 2020, KPMG released its special audit report. The findings were damaging. KPMG stated it could not confirm the existence of substantial portions of Wirecard's revenue and profits. The auditors found missing or incomplete documentation for transactions involving third-party acquirers. They noted discrepancies in contracts, invoices, and bank statements. KPMG stopped short of declaring fraud but stated that it was unable to obtain sufficient evidence to verify key financial figures. Wirecard's stock plummeted. The company insisted that the issues were merely documentation gaps, not evidence of wrongdoing. But confidence in Wirecard was evaporating. Following KPMG's inconclusive report, Ernst & Young faced a critical decision: could it sign off on Wirecard's 2019 annual accounts? EY requested additional evidence to verify cash balances that Wirecard claimed were held in trust accounts at banks in the Philippines and Singapore. The amounts in question totaled €1.9 billion, funds that Wirecard said belonged to clients but were managed by third-party trustees. EY asked for bank confirmations directly from the trustees. Wirecard provided letters and documents. But EY's doubts grew. The firm set a deadline: without credible proof of the cash, EY could not certify the accounts. In mid-June 2020, Wirecard disclosed that the trustee bank accounts could not be verified. The company announced that 2 Philippine banks, BDO Unibank and Bank of the Philippine Islands, had told Wirecard's auditors that the accounts in question did not exist. Wirecard's management scrambled to explain. They suggested the possibility of forgery or fraud by third parties. The Financial Times reported that documents provided to EY appeared to contain forged signatures and false statements. BDO and BPI publicly confirmed they had no business relationship with the trustees named by Wirecard. The €1.9 billion was missing. On June 22, 2020, Wirecard issued a statement that would seal its fate. The company admitted that the €1.9 billion in cash balances likely did not exist. In a press release, Wirecard stated, "There are clear indications that this was an elaborate and sophisticated fraud involving multiple parties around the world." The admission was extraordinary. A DAX-listed company was conceding that a quarter of its balance sheet was fictitious. Investors who had trusted Wirecard's audited accounts faced catastrophic losses. The German government, which had championed Wirecard, was left scrambling for answers. Hours after Wirecard's admission, CEO Markus Braun resigned. The following day, June 23, German prosecutors arrested him on suspicion of accounting fraud and market manipulation. Braun was held briefly, then released on €5 million bail. He maintained his innocence, telling investigators he had been deceived by subordinates and third parties. Braun claimed he was a victim of the fraud, not its architect. Prosecutors, however, alleged that Braun had knowingly inflated Wirecard's revenue and balance sheet to attract investors and secure loans. The criminal investigation was only beginning. While Braun was arrested, Wirecard's chief operating officer, Jan Marsalek, disappeared. Marsalek, an Austrian executive who had joined Wirecard in the early 2000s, oversaw the company's operations in Asia, the region at the center of the fraud allegations. On June 18, Wirecard suspended Marsalek. On June 19, he was fired. By June 22, he had vanished. German authorities issued an arrest warrant for Marsalek on suspicion of fraud and embezzlement. Interpol issued a red notice. But Marsalek had fled Germany. His whereabouts became one of the most intriguing mysteries of the scandal. Investigators later pieced together Jan Marsalek's escape. According to German media reports, Marsalek flew from Austria to Belarus on June 19, 2020. From there, he is believed to have traveled to Russia. Marsalek had long-standing ties to Eastern Europe and allegedly maintained contacts in intelligence circles. Some reports suggested he had relationships with Russian officials, though these claims remain unverified. As of this script's writing, Marsalek remains at large. German prosecutors have charged him in absentia with fraud, breach of trust, and market manipulation. His current location is unknown. On June 25, 2020, Wirecard AG filed for insolvency at the Munich District Court, citing over-indebtedness and impending illiquidity. The company's creditors were owed approximately €3.5 billion. Thousands of employees faced job losses. Clients scrambled to move their payment processing to other providers. The insolvency marked the largest corporate collapse in post-war German history. An insolvency administrator was appointed to wind down Wirecard's operations and recover assets for creditors. The chances of recovering the missing €1.9 billion were slim. Investigators believed much of it had never existed in the first place. Wirecard's collapse wiped out billions in shareholder value. At its peak in 2018, Wirecard's market capitalization exceeded €24 billion. By late June 2020, its shares were worth virtually nothing. Institutional investors, including BlackRock, Vanguard, and German asset managers, suffered heavy losses. Retail investors who had trusted Wirecard as a blue-chip German stock were devastated. Pension funds and mutual funds that held Wirecard shares faced scrutiny for their due diligence failures. The scale of the losses was staggering, and the reputational damage to Germany's financial system was profound. Wirecard's creditors included major banks that had extended loans based on the company's reported financial health. According to filings, Wirecard owed approximately €1.75 billion to a consortium of 15 banks, including Commerzbank, ABN AMRO, and ING. These loans had been secured on the basis of audited financial statements that turned out to be false. The banks faced the prospect of massive write-downs. Some lenders launched internal reviews to determine how Wirecard had passed their credit assessments. The scandal raised uncomfortable questions about the banking sector's reliance on audit opinions and its own due diligence practices. Wirecard's collapse triggered a political crisis in Germany. Chancellor Angela Merkel and Finance Minister Olaf Scholz faced criticism for their support of the company. Scholz had lobbied on Wirecard's behalf during a 2019 visit to China, seeking regulatory approvals for the firm's expansion. BaFin, the financial regulator, was accused of incompetence and regulatory capture. Felix Heufeld, BaFin's president, admitted the regulator had failed. The German parliament established a committee of inquiry to investigate the regulatory failures and government involvement. The scandal became a symbol of Germany's difficulty in adapting to the digital economy and its vulnerability to corporate fraud. In the aftermath of Wirecard's collapse, Ernst & Young faced intense scrutiny. Germany's financial regulator, APS, the auditor oversight body, launched an investigation into EY's audits of Wirecard. Prosecutors opened a criminal probe into EY auditors for possible breach of duty. Investors filed lawsuits seeking damages. Critics asked how EY could have signed off on Wirecard's accounts for 11 consecutive years without detecting a multi-billion-euro fraud. EY maintained that Wirecard's management had engaged in an elaborate deception, using forged documents and collusion with third parties to mislead auditors. The firm argued that it too was a victim of the fraud. As investigators examined Wirecard's records, evidence of systematic fraud emerged. Prosecutors alleged that Wirecard executives had used fake contracts, fabricated invoices, and forged bank statements to create the appearance of profitable business in Asia. Internal emails and documents suggested that senior managers knew the third-party revenue was fictitious. Forensic accountants traced funds through a labyrinth of shell companies and offshore accounts. Some money appeared to have been siphoned off for personal use, other funds were used to service Wirecard's debt and maintain the facade of financial health. The complexity of the fraud made it difficult to quantify the full extent of the losses. By 2021, German prosecutors had filed extensive criminal charges. Markus Braun was charged with fraud, breach of trust, and market manipulation. Investigators alleged he had knowingly falsified Wirecard's accounts from 2015 onward. Jan Marsalek, in absentia, faced similar charges. Several other Wirecard executives and employees were also charged, accused of participating in or enabling the fraud. Prosecutors alleged a conspiracy involving Wirecard managers, employees at the third-party acquirers, and external accomplices. The criminal trial of Markus Braun began in December 2022 in Munich. Braun continued to deny wrongdoing, claiming he was unaware of the fraud. At trial, Markus Braun maintained that he was a victim of fraud orchestrated by Jan Marsalek and others. Braun's defense argued that Marsalek, as COO, controlled operations in Asia and concealed the fictitious transactions from Braun and the board. Braun testified that he trusted his subordinates and relied on EY's audits. Prosecutors countered that Braun had actively participated in the fraud, citing internal documents and witness testimony. They alleged Braun had pressured employees to inflate revenue figures and had personally benefited from the rising stock price. As of this script's writing, the trial is ongoing, and no final verdict has been reached. Investigators traced the fraud to a network of companies in Asia, particularly in Singapore, the Philippines, and Dubai. Wirecard had acquired or partnered with payment processors in these jurisdictions, which allegedly generated inflated revenue. Prosecutors identified several shell companies that existed only to facilitate circular transactions. Bank accounts in Singapore and the Philippines received funds from Wirecard, then returned them through a series of transfers disguised as customer payments. Some individuals linked to these entities were arrested and charged. Others, like Marsalek, remained fugitives. The international nature of the fraud complicated prosecution and asset recovery. Wirecard's collapse prompted regulatory reforms in Germany and the European Union. Germany overhauled BaFin, granting it broader powers to investigate companies and audit firms. The EU proposed stricter rules for auditor independence and rotation, aiming to reduce conflicts of interest. Lawmakers debated whether external auditors should be held criminally liable for negligence in fraud cases. The Financial Times reporting was vindicated, and press freedom advocates argued that BaFin's attacks on journalists had chilled investigative journalism. The reform sought to prevent a repeat of Wirecard, but critics questioned whether the changes addressed the root causes: lax oversight, regulatory capture, and excessive trust in audited accounts. The human cost of Wirecard's fraud extended beyond investors. Thousands of Wirecard employees lost their jobs when the company collapsed. Many had invested their savings in Wirecard stock, believing in the company's future. Some merchants and clients who relied on Wirecard's payment processing faced disruptions and financial losses. Pension funds that held Wirecard shares saw the value of retirees' savings evaporate. The scandal eroded trust in German corporate governance and the DAX index. For many, Wirecard became a cautionary tale about the dangers of unchecked growth, regulatory complacency, and the seductive power of a compelling corporate narrative. Wirecard's insolvency administrator, Michael Jaffe, worked to recover assets and compensate creditors. In 2020 and 2021, parts of Wirecard's business, particularly its card issuing and payment processing operations, were sold to competitors. The sales generated several €100 million, a fraction of the company's debts. Jaffe pursued legal claims against former executives, auditors, and banks. He also sought to recover funds from the offshore entities and shell companies linked to the fraud. The recovery process was expected to take years. Creditors were told to expect only a small percentage of their claims back. The Financial Times and its investigative team received widespread recognition for their dogged pursuit of the Wirecard story. Dan McCrum and his colleagues were awarded the Financial Journalism Award and other honors. Their reporting, once dismissed by regulators and attacked by Wirecard, was now seen as a landmark case of investigative journalism holding power to account. The FT's experience highlighted the risks journalists face when reporting on corporate fraud, legal threats, regulatory hostility, and public skepticism. McCrum later wrote that the Wirecard investigation demonstrated the importance of independent media and the need for regulators to take whistleblowers and investigative reporters seriously. Despite extensive investigations, key questions about Wirecard remain unanswered. How much money was actually stolen, and where did it go? Who else, beyond Braun and Marsalek, participated in or knew about the fraud? Did external parties, banks, consultants, or foreign officials enable the scheme? And why did so many gatekeepers, auditors, regulators, analysts fail to detect the fraud for so long? Some answers may emerge during ongoing trials and investigations. Others may never be known, especially if Jan Marsalek remains a fugitive and key evidence is destroyed or hidden. Wirecard's collapse will be studied for years as a case study in corporate fraud and regulatory failure. Wirecard's scandal exposed vulnerabilities in global financial oversight. It showed that even large, publicly traded companies audited by prestigious firms can engage in systemic fraud. It demonstrated that regulators may be captured by the industries they oversee, reluctant to challenge national champions. It revealed that auditors, despite their critical role, may lack the tools or incentives to detect sophisticated fraud. And it underscored the importance of skeptical journalism and short sellers in uncovering corporate misconduct. The Wirecard case became a reference point in debates about audit reform, regulatory independence, and the limits of financial due diligence. For Germany, Wirecard was a national humiliation. The country prided itself on engineering excellence and financial stability, yet it had failed to detect one of the largest frauds in European history. Wirecard's collapse damaged Germany's reputation as a safe destination for investment and raised questions about the quality of German corporate governance. It also highlighted the country's struggles to nurture successful technology companies. Wirecard had been hailed as a rare German tech unicorn, and its failure left a void. The scandal prompted soul-searching among policymakers, investors, and business leaders about what went wrong and how to prevent similar failures in the future. The Wirecard scandal prompted a reckoning for the audit profession. Critics argued that auditors had become too cozy with clients, prioritizing fee revenue over independence. They pointed to conflicts of interest when audit firms also provide consulting services to the same clients. They questioned the effectiveness of sampling-based audits in detecting sophisticated fraud. Proposed reforms included mandatory audit firm rotation, bans on non-audit services, and criminal liability for auditor negligence. Some advocated for a fundamental rethinking of the audit model, with greater use of technology and forensic techniques. The Wirecard case became Exhibit A in arguments for audit reform. Wirecard also offered hard lessons for investors. The scandal demonstrated that audited financial statements, even from reputable firms, are not infallible. It showed that regulatory approvals and stock index membership do not guarantee a company's integrity. It highlighted the value of independent research, including short seller reports and investigative journalism, which institutional investors often dismiss. And it underscored the risks of investing in companies with opaque business models, aggressive growth narratives, and limited disclosure. Many investors who lost money in Wirecard had ignored red flags, seduced by the promise of high returns and the comfort of external validation. For regulators, Wirecard was a failure of oversight and judgment. BaFin's decision to side with Wirecard against journalists and short sellers demonstrated regulatory capture and a misplaced faith in national champions. The scandal showed that light-touch regulation, reliant on auditors and self-reporting, is insufficient when management is determined to commit fraud. It revealed the need for proactive, skeptical oversight, including the ability to conduct surprise inspections and forensic audits. And it underscored the importance of cross-border cooperation, given the international nature of modern financial fraud. Wirecard became a case study in how not to regulate. As of this writing, the criminal trial of Markus Braun continues in Munich. Prosecutors have presented extensive evidence, including internal emails, witness testimony, and forensic accounting reports. Braun's defense has challenged the credibility of witnesses and argued that the prosecution's case relies on circumstantial evidence. Other defendants, including former Wirecard managers and employees, have been tried separately or are awaiting trial. Jan Marsalek remains a fugitive, and prosecutors have indicated they will try him in absentia if he is not apprehended. The trials are expected to continue for years, and final verdicts may not come until the mid-2020s. Jan Marsalek's disappearance has captivated investigators and journalists. Reports suggest he may be living in Russia under state protection, though Russian authorities have not confirmed his presence. Some investigative outlets have reported that Marsalek had links to Russian intelligence services and may have provided information or services in exchange for refuge. Austrian and German authorities continue to search for him, and Interpol's Red Notice remains active. Marsalek's ability to evade capture has fueled speculation about high-level assistance and the difficulty of prosecuting international white-collar criminals. His story has become a symbol of impunity in cross-border fraud cases. Ernst & Young has faced significant reputational and financial consequences. Lawsuits filed by investors and creditors seek billions in damages, alleging that EY's negligence enabled the fraud. In 2021, Germany's audit regulator imposed a €500,000 fine on EY, and barred two auditors from auditing public companies. EY's global leadership acknowledged mistakes but maintained that the firm was deceived by a criminal conspiracy. The firm has invested in new fraud detection technologies and revised its audit procedures. Nonetheless, the Wirecard scandal has tarnished EY's reputation and prompted clients and regulators to scrutinize the firm's work more closely. Wirecard's story is a cautionary tale for the modern financial system. It is a story of unchecked ambition, regulatory failure, and the fragility of trust. It shows how a company can rise to prominence through a combination of genuine innovation and outright fraud, and how gatekeepers, auditors, regulators, analysts can fail to detect deception. It demonstrates the power of investigative journalism to uncover wrongdoing, even in the face of legal threats and official skepticism. And it underscores the devastating consequences of financial fraud for employees, investors, and the broader economy. Wirecard's collapse will be remembered as one of the defining corporate scandals of the 21st century. The central mystery of the Wirecard scandal, the €1.9 billion that likely never existed, remains a symbol of the fraud's audacity and scale. That sum represented nearly a quarter of Wirecard's balance sheet and was critical to maintaining the illusion of financial health. The fact that such a large amount could be fabricated and go undetected by auditors and regulators for years is a damning indictment of the system. Whether any of the money was real, or it was supposed to have been, and what happened to funds that did exist are questions that may never be fully answered. The missing billions are a reminder of the limits of transparency in global finance. Wirecard's legacy is one of fraud, failure, and hard-won lessons. The scandal has prompted reforms in auditing and regulation, though whether those reforms are sufficient remains to be seen. It has vindicated the role of skeptical journalism and short sellers in financial markets. It has damaged Germany's reputation and exposed weaknesses in European financial oversight. And it has left thousands of victims, employees, investors, creditors struggling with the consequences of a fraud that was years in the making. As trials continue and investigations proceed, the full story of Wirecard is still being written. But the core lesson is clear: in finance, trust must be earned and verified.